Hello, everyone. My guest today is Olin Hyde. He's the CEO and co-founder at LeadCrunch AI, one of the fastest growing MarTechs in history. They're ranked number 2 in marketing in the marketing industry, number 35 overall in the 2020 Inc. 5000. He was a finalist for EY Entrepreneur of 2020 in San Diego. He's an 8X serial entrepreneur with 2 exits. Olin, you ready to take us to the top?
I am. Thank you so much, Nathan.
All right. So first off, you have a very interesting billing model. Before we get to that, because I think it's the future, I want to talk about what LeadCrunch is for those that missed the first one. What do you do for B2B SaaS companies?
So LeadCrunch is a B2B marketing platform that finds the ideal targets and then delivers the ideal audiences based on buying signals. So we find your ideal customer profile and then detect the buying signals that indicate those ideal prospects need your product or service.
So you might track the clicks of that person through the web and notice they're looking at your competitor pages. This is it reminds me a lot of like what Eric at Bombora is doing. Is it similar?
We are complementary to Bombora. Bombora is doing what's really called intent, and it's around looking for things on the web. What we're looking for is we look at about 40 billion data points on about 10 million companies.
Okay.
And you can think of our technology as modeling out how companies fit into each other's supply chain. So we're actually looking at things like, is your company an early adopter? Is your company have a high need for communication services? Is your company have a high cybersecurity threat? These are the things you can't look up on a database, and they're the things that would augment what Bombora is doing.
Yeah. Now, you're not charging. A lot of SaaS companies, they have churn issues because they charge a flat fee per month, and then whatever the utility is doesn't actually get used, and then people churn. You said, screw that. We're going to bill on a CPL, a cost per lead model. Tell me about that.
Yeah, we really believe in billing on actionable intelligence. And when you're generating demand for your company, it's not a commodity. People are not commodities. They have different values. And so when we first started, we thought, well, we should really charge a percentage of customer lifetime value or a percentage of customer acquisition cost. And we found early in our history that we couldn't get that data in any way. Hard to track. So what we decided to do is charge on a cost per lead basis where we can estimate the general cost of customer acquisition, the general value of that lead across a campaign. And so the good news is that our net revenue retention, which is a metric a lot of SaaS companies track, it's about 138% quarter to quarter. Mm-hmm. So that, and it started off much lower than that. I think the last time we spoke, we didn't want to reveal it because it was probably below 100%, and it's crept up.
Yeah, you said in 2017, 100%, and then in 2019, 130%. Peel that onion back for me though today. So 138% quarter over quarter. What, 2 components make that up: gross, dollar turn on a gross basis, and then expansion on a dollar basis. What are those 2 metrics?
Most of it is expansion. We actually our gross revenue retention, which would be, you can think of that as the logos from prior quarter spending in this quarter, is only at about 80%. Mm-hmm. And that's because we had a big dip in the first half of the year.
Wait, what do you mean by that? Only 80% churn?
No, that would be if you have 100 customers in the first quarter and they spend $100 each. The next quarter, $100 still spent each, but only 80 of them are buying. So we lose about 20% of our existing logo revenue per month, while the other side's growing at almost 40%. So same customer revenue increases dramatically, whereas the overall customer base is shifting as we move from SMB into the enterprise. We're dropping off some of our less than ideal customers right now.
So Olin, let's move away from logo churn because of that trend. That's why I want to dig onto dollar churn. So I'm going to use your same exact example: 100 customers today paying $100 a month. Next month, 80 churn. But the ones that are left are not, hopefully, still only paying $100 a month. Ideally, they've expanded. That's what I want to know.
Yeah, it's not an 80 churn. It would be a 20% churn.
Sorry, that's what I meant. But you get my point.
Right. Yeah, and the others are paying, in some cases, 6-7 times X.
But what is it? I mean, when you take the total revenue amount from those 100 in 1 month, and then the next month, a portion of them churn, cancel revenue, and then they expand by X dollars, what's the churn on a revenue basis and the expansion on a revenue basis?
We don't track it like that. And I could certainly pull those numbers. I don't have them off the top of my head.
Mm-hmm. Okay. All right, got it. So basically what you're telling me is net, a cohort from a year ago or a quarter ago is paying 138% more because they're using more. They're using you more leads.
Correct. That's on a net basis.
Yeah. Okay, interesting. Last time we spoke, you were testing some different customer sort of generation inbound methods. Talk to me today. How are you getting new customers, and how many customers do you have?
We're going to do $2 million of revenue this month, which is our best month ever. And almost all of it is from customers that were here in October and November. Unfortunately, we have not been able to do a lot of marketing because we've been so busy just keeping up with demand from current customers. We track our inbound leads through a multi-touch attribution method. And of our current, we will run about 150 campaigns this month. Rather, 150 different companies will be running campaigns for this month. 74 of them are new customers in the past 6 months. Mm-hmm. And of those 74, about 40 of them are from inbound marketing.
Mm-hmm. Interesting. Okay, so 40 new inbound. And what's the general size of the initial contract folks spend with you? The first month they pay you X. Yeah.
Yeah, we don't like to do anything less than 10,000, and that's really going away. The average right now for a first-time order is around 50,000.
Okay, and how many leads would you deliver them if this is a tool like Monday.com or ClickUp, a team productivity tool?
Yeah, I love ClickUp. They're a San Diego company, just raised $100 million in their Series B. Awesome. So
not just that, it was one of the fastest rounds I've seen from, they just literally 2 months ago did a $33 million round at a $500 million valuation, then $100 million at $1 billion value. It was the fastest I've ever seen that happen.
Yeah, well, I'm going to buy your report just to see the number. There's a plug for you.
Yeah.
So I think your question was, what is our price per lead?
Yeah.
It depends upon the specification. So it can be as low as, say, 50, and our most expensive that we've ever sold is 1,200
per lead.
You can per lead.
Yeah.
So you can think of an average of around 75 is a number that.
What was the low end?
The low end is around 50.
Okay, so 50 to 1,200, average 75. Interesting. Okay, what's a $1,200 lead? Like, what is it, like a hedge fund or something?
Yeah.
Yeah. Oh, what is a hedge fund?
Well, it's somebody selling very, very expensive things, maybe like airplanes or financial packages to large corporations, those type of things. They're not big lead packages. They take a lot of work to go through. And so that package may only include, say, 100 leads, but they're very expensive.
Well, listen, congrats on the growth. I mean, last time you were on in 2019, you were doing about, 20 million in terms of 1.6, 1.7 million a month. You're now up to 2 million a month, or 24 sort of run rate. So right. Congrats on the growth in a tough year for everybody. Have you raised additional capital?
We have not. Well, the last raise we did was about 2 years ago, I think. Yep. We still have plenty of dry powder in the bank. We are profitable for the past 3 months.
Oh, wow. How much? Can I ask how much?
This month we'll have about 400,000 of EBITDA on about 2 million of revenue.
Oh, and how on earth does your board, who want you reinvesting in growth, let you sit on a 20% EBITDA margin?
20% EBITDA. Yeah, so I think that our philosophy is we've really been inspired by John Singleton and the whole theory of cash management. So we will spend money aggressively when we know we can get growth that is responsible and sustainable. I really am a big fan of managing expenses. We've been very capital efficient. Our company's raised a total of about $20 million and have revenues that are similar to companies that have raised $100 million. Yep. So I think there's such a thing, and this applies to me. I'm not saying this is true for everybody. There's such a thing as raising too much money. It creates problems for founders where you can't clear preferences. There's a problem with raising money at too high a valuation. So from our perspective, we really want to deliver remarkable returns to our investors, and we want to raise the right amount of money to capture the market. And you can expect us to do a round in another year that would be a large Series C. And what we're using our capital now for is what I call small bets. let's go out and see what channels work for us. And when we start to see one work a lot, we'll spend a lot of money on it. It will pay for itself. And then we know what we'll do with our Series C.
Your last run, I believe, was an $11 million round in 2018. Is that right?
Yeah, it was about, I think, a little bit more than that, but that's the ballpark. Yeah.
And sold sort of what you see most companies sell, something like 10 to 15% of the business?
Yeah, it's a little bit more than that. I think that we raised 12.5. I mean, I don't think there's any secret. Our post-money valuation was 56 million.
Okay. And if you go out in 2021 and try and raise, what valuation do you think you can command? Obviously, the combination of metrics plus your ability to storytell.
Yeah, well, I think that that's the job of the VCs. I can tell you in general, I'm not interested in raising a round that's not, it's got to be a big enough round for us to take the company all the way to an IPO. Mm-hmm. And I think in our world, that's a number north of 30 million and less than, say, 60 million. Yeah. I know that's a big range, but that's the ballpark that we expect the valuation to justify.
Yeah. So what you're saying is you want to get a check size in of 30 to 60 million without selling more than, call it, 15% of the business. So you really need an angle to figure out, can you get, 15 to 20x multiple on a 24 million run rate or something like a $300 to $400 million post-money valuation?
Yeah, maybe. Yeah, I think we'd be willing to take a little bit more dilution than what you just outlined. I think that 10 to 15% is pretty aggressive. VCs...
Aggressive or conservative? You'd sell more than 15% for 30 million?
Yeah.
Okay, got it.
Yeah. I'm sorry if I reverse those. It depends upon the perspective, which side you're on the table and what's conservative. I think that, the good VCs add a tremendous amount of value and add a lot to your exit value because they've done it a lot of times. They bring a lot of experience. And so I think that it's more important to get the right team than the ideal valuation. And I've seen a lot of companies, again, raise a too high a valuation or raise too much money, and they can afford to be stupid or make more mistakes. I think there's a real value in capital efficiency. We're not seeing that in the market right now simply because there's so much money on the street. But I think in a couple years from now, likely the business cycle will be at the stage where capital efficiency is people will pay a premium for it.
Yeah. And talk to me about team today. How many folks on the team?
35.
35. Okay. How many engineers?
Well, we separate our product engineering, our code engineering, and our data science. So let's treat all of them the same.
Yep.
12.
Okay. And how many quota-carrying sales reps?
5.
Interesting. Okay, so these are down since 2019. And maybe you told me 72 in 2019. You're down to 35 now. You cut your engineering staff in half, and you kept the same number of sales reps, it sounds like.
Yeah, it's actually, we were at 75, and then I did 3 layoffs.
Okay, tell me about those. Those are tough.
Yeah, it's painful. So we went into Q1, things were looking great, Q1 2020. Q2, the floor fell out from underneath us. And we were in the wrong place in the market. And we had already started the migration into the enterprise accounts. And we really had a tough second quarter. We basically lost the quarter. So this year, we're going to end the year about exactly where we were last year. So it's, the kind of the jokingly way to say it is flat is the new up.
Yeah.
The second half of this year has just been amazing growth for us. But the first half was the other direction. Mm-hmm. And so what happened is, unfortunately, I think the skills that get you to 10 million are a lot different than the skills that get you to 20, 30, 40 million. And we had some amazing team members that we'd outgrown or they had outgrown us. And we really wanted to pare our team down. And one of the key metrics that I use is I think of valuation per employee. So you can think of that as how much revenue per employee, what's your gross margin per employee. And so we wanted to increase that a lot and really pare our team down to have a smaller team where we were a lot more efficient and we could go a lot faster in one direction. And that's something that we were successful in doing. And now it's time to start building the team back up.
$24 million run rate, 35 employees puts you at, again, way above average, $685,000 in revenue per employee. Average in public companies, you see about $195,000 in revenue per employee in the SaaS space. So makes sense there. Where will your next hires be, you think?
Well, we've got 9 open positions right now. We're going to expand our sales team. We're going to expand our engineering team, and we're going to expand our product team. Yep. So it's really the old mantra that Peter Drucker said, a company has 2 functions, marketing and engineering. I would say the company has 2 functions, sales and product engineering. And that's where we want to focus on right now.
All right, Olin, let's wrap up here with the famous 5. Number 1, favorite business book?
The Outsiders.
Yep. Yeah. It does not surprise me you would say that book with how you talk about capital efficiency and Singleton. Number 2, is there a CEO you're following or studying?
Many. Everyone should be following Reed Hastings and Jeff Bezos. They're 2 of the smartest guys ever. But there's many. There's a few local ones here that I love a lot too. So, I think Doug Winter over at Seismic's doing a remarkably good job.
Number 3, what's your favorite online tool for building LeadCrunch besides your own?
Wow, there's a lot of those too. I'm really in love with, it sounds so simple, but we couldn't live without the Google Office suite, the Google Docs and that so forth. It's amazing what you can get done with that and Slack.
Number 4, how many hours of sleep are you getting every night?
I get at least 8, and I measure my sleep with a Whoop tracker. Fortunately, during this pandemic, I lost 25 pounds and got in shape. And if it can be measured, I like to measure it. And I measure my sleep and really pay attention to make sure I get 8 hours of sleep a night.
And Olin, what's your situation? Married, single, kiddos?
Married with adopted kids.
How many kids?
3 nieces and 1 nephew. A lot of them have started to grow out of the house now. We've got one that's graduating from college, 2 that are in college, and then we've got an 8-year-old.
Okay, but you've adopted 4 kids.
Yeah, we're guardians, so they put time between us and their parents.
How
and
cool.
So it takes a village to raise these kids.
I love that. Okay, and how old are you?
I am 55 years of age.
Last question. What do you wish you knew when you were 20?
I wish someone at 20 would have said, it's not enough to be smart. The only thing that really matters is hard work. And don't misinterpret your luck with skill.
Guys, there you have it. Olin Hyde, LeadCrunch.ai. They did $2.4 million in revenue back in 2017, have since scaled in 2019 up to about $20 million in revenue. In 2020, this year, they're now doing $2 million a month. So healthy growth rate year over year. They're also profitable, $400,000 per month for about a 20% EBITDA margin. They're also scaling their team size down. So they're more capital efficient, generating almost $700,000 in revenue per employee before they look to scale next year, targeting a $30 million round at somewhere around a $200 or $300 million valuation. Olin, thanks for taking us to the top.
Thanks so much, Nathan. Have a great day.
One more thing before you go. We have a brand new show every Thursday at 1 p.m. Central. It's called Shark Tank for SaaS. We call it Deal or Bust. One founder comes on, 3 hungry buyers, they try and do a deal live, and the founder shares back-end dashboards, their expenses, their revenue, ARPU, CAC, LTV, you name it, they share it. And the buyers try and make a deal live. It is fun to watch every Thursday, 1 p.m. Central. Additionally, remember, these recorded founder interviews go live. We release them here on YouTube every day at 2 p.m. Central. To make sure you don't miss any of that, make sure you click the subscribe button below here on YouTube, the big red button, and then click the little bell notification to make sure you get notifications when we do go live. I wouldn't want you to miss breaking news in the SaaS world, whether it's an acquisition, a big fundraise, a big sale, a big profitability statement, or something else. I don't want you to miss it. Additionally, if you want to take this conversation deeper and further, we have by far the largest private Slack community for B2B SaaS founders. You want to get in there. We've probably talked about your tool if you're running a company or your firm if you're investing. You can go in there and quickly search and see what people are saying. Sign up for that at nathanlatka.com/Slack. In the meantime, I'm hanging out with you here on YouTube. I'll be in the comments for the next 30 minutes. Feel free to let me know what you thought about this episode. And if you enjoyed it, click the thumbs up. We get a lot of haters that are mad at how aggressive I am on these shows, but I do it so that we can all learn. We have to counter those people. We got to push them away. Click the thumbs up below to counter them and know that I appreciate your guys' support. All right, I'll be in the comments. See ya.